You can spend months building a profitable, back-tested strategy, perfectly tuned to the market, and still watch your live account suffer a slow, inexplicable bleed. The numbers behind this are brutal. Up to 96% of day traders completely fail, draining their entire capital reserve before they ever reach consistency. When you dig into the data on why this happens, it rarely comes down to a lack of technical knowledge. These traders know how to read price action, they understand market structure, and they know what a good setup looks like. The breakdown happens somewhere else entirely. A proven mathematical edge carries zero value if you lack the precise position sizing, the stop-loss discipline, and the emotional control required to actually execute it. Possessing a winning strategy does not automatically make you a winning trader. Flawless execution in live, high-pressure markets is the ultimate filter separating the professionals from the amateurs. Professional traders step into the market prioritizing one thing above all else: protecting their existing capital. Beginners, on the other hand, fixate almost entirely on the potential reward of the setup right in front of them. This diagram illustrates the 1% rule. It establishes a hard ceiling on risk. You never expose more than 1% of your total account equity on any single trade. If you hit a losing streak, this math ensures your capital survives to trade another day. But watch what happens when a trader enters a position, sees the price drop, and decides to move their mental stop-loss mid-trade just to give the position a little more room. By doing this, they actively break their mathematical edge. That controlled risk balloons, doubling or tripling the expected loss. The exact second you deviate from your predefined risk parameters, you are no longer trading your proven strategy. You have reverted to gambling. That initial, poorly managed loss is rarely what ends a trading career. It is the psychological fallout immediately after. A sudden, oversized hit triggers deeply ingrained cognitive biases that bypass logic entirely. This table outlines the specific psychological barriers traders face. Look at the row for revenge trading. When anger and frustration peak, a trader will often double their position size to force the market to pay them back. What started as a standard loss rapidly scales into a massive deficit. Right above that, we see the results of overtrading. Amateurs often operate under the myth that executing a higher volume of trades will naturally generate more opportunities to profit. In reality, forcing low-quality, out-of-system setups because of boredom or emotional tilt does nothing but accumulate transaction fees. It slowly erodes whatever profits you manage to pull from your valid setups. The market itself rarely destroys an account in a single blow. It is almost always the trader's emotional reaction to a completely normal loss that triggers the fatal downward spiral. Even the most perfectly calibrated strategy on Earth is going to hit periods of normal market variance. Temporary losing streaks are an unavoidable mathematical certainty. This document examines the role of trading journals, highlighting a massive blind spot. Without automation and clear data visualization, traditional notes lack the structure needed to turn raw data into an actionable strategy. When you hit a draw atom without objective numbers to review, you are flying blind. This leads straight into the comfort trap. Instead of analyzing their own execution errors, the trader blames the market conditions. They abandon their entire approach before they've even gathered a minimum 100 trade sample size. Constantly hopping from one new strategy to the next resets your progress back to zero. It locks you into a cycle of forever chasing the illusion of a flawless, loss-free system. If you aren't tracking precise execution data, you cannot answer the most critical question in trading. Did the strategy fail the market conditions, or did you simply fail the strategy? To survive, you must undergo a massive identity shift. You have to stop acting like a reactive gambler and become a data-driven business operator. The harsh truth is that normal human psychological wiring is entirely incompatible with profitable trading. Our brains are terrified of realizing losses and eager to lock in tiny wins. You need external systems to override those natural instincts. You do this by isolating your behavioral flaws from your actual strategy performance. That means tracking strict quantitative metrics, like your R multiple, which measures your actual risk against your final reward, or measuring your accuracy across different times of the day. Measured historical beta serves as a mechanical defense against the emotional cognitive biases that consistently cause account blowups. This is where TradeZella becomes an essential tool. It acts as an analytical bridge designed specifically to help you pinpoint and close your exact execution leaks. The platform works like a digital mirror. It calculates your R multiples, tags your behavioral mistakes, and proves your statistical edge through rigorous backtesting. It also features a trade replay tool. You can visually audit your exact entries and exits second by second to see precisely where your discipline broke down during a live session. Most traders have all the technical knowledge they need. They fail with winning strategies solely because they lack the tools and the discipline to execute them consistently over time. Stop the slow bleed. Master your execution. Click the link in the description to get 20% off a TradeZella subscription today.